Hi, thank you very much. It's a pleasure to be here. To speak English in my own country is also kind of awkward, but doesn't matter. So I'll do what all discussants should do. First is to summarize the paper very briefly, how I understand. Usually when I go to conferences, I wait for the discussant to do that because I never understand the guy that's presenting the paper. So it's, the second thing that I will do, I'll do some general some comments on the paper, and then do a more general discussion on these issues about foreign exchange intervention and reserve accumulation. So let me just try to summarize the paper very briefly. But there are two reasons for foreign exchange rate to be effective. The first is because foreign and domestic assets are imperfect substitute. So as long as you are able to change relative supplies, you will change relative prices. So this is even before Dan Bacchus-Quijo, we knew this. I don't know of references, but I think that's quite old. And then it came the balance, the portfolio balance. I think that Lars can tell us about people that wrote about this much before us. So, and the second is the signaling channel. So this is a signal channel that when you intervene is an indication that you may move then monetary policy. And monetary policy is unsterilized intervention, changing the interest rate. Or even in emerging markets, that is a signaling that then you will use capital controls or do things. And so it's this paper is based on the imperfect asset substitution. Basically, domestic and foreign assets are not exactly the same because at some point there is a friction, which is a credit constraint. So you cannot substitute a asset in order to increase lending, because you have a constraint. So this is it. There is some caveat, because in this paper, most of the paper is done in an economy without money. So you say, well, and you say, where is the currency and the price, the relative price of currencies? So in this paper, the intervention changes the relative price, the real exchange rate, because there is a real friction. So let me just try to explain the model very briefly. The central bank has reserves, the liabilities, and only sterilization bonds. So and buys and sells sterilization. Sorry, the reserves are the assets, but this is because I didn't check it. So has foreign reserves, and the equilibrium is the balance sheet is foreign reserves equal sterilization bonds, which are government bonds, are government securities, and the central bank uses to intervene and to change the balance sheet of banks. Then banks have two assets. One is a sterilization bonds, so it's a borrowing from the central bank. The second are loans. That's what banks do. In this country, just with a foreign currency, with liabilities, you have a foreign borrowing and you have net worth K. So you have that loans plus sterilization bonds are equal to equity plus equity net worth and foreign borrowing of banks. Here, there is an important constraint. I think that because this paper has sort of three frictions, not one. This is only domestic agents can hold sterilization bonds. Basically, if you need money to lend, you cannot go sell the bonds abroad, take those proceeds, and go and lend. No, you just have. Banks are the only ones that trade bonds, so this is quite important. Then there is this imperfect capital mobility that sometimes bind, and this is interesting in the paper because sterilized intervention is not always effective. Only when this constraint is binding, which is you have a theta and you can borrow at most theta of your net worth. That's it. The third constraint, which is also important for the paper, is that household decides what all reasonable households do, leisure, consumption, savings, and all the stuff, plus also equity in banks. But they face a constraint on equity. They cannot hold unlimited amount of equity in the bank. They have a constraint K prime. It used to be in the paper K bar, but I had a problem with the fonts in I did it, so it's K bar. When this constraint binds, banks can make extra profits, and they borrow at R star, and they lend at rho. Okay, so there is a borrowing constraint, and this is a two two states of the economy. Here, the constraint is binding, and here, the constraint is not binding, and we have no spread. So this is basically the paper. Then in an economy without a domestic currency, a sterilized intervention has effect because it changes consumption of home goods and export relative consumption, and it affects the relative price, which is the real exchange rate. When the economy is credit constrained, the intervention have real effects. I couldn't get the intuition. And this is a general problem when you have problems that the authors that they say, this paper is a simple model, but in order to solve it, I use Ogbin, which is an adaptation of Dinare, and this is okay, fine. And I didn't get it. So I tried to look at some constraints that you have and see at some value effects and some value effect and substitution, what's happened with consumption, with the labor supply. Because if I would have to do it simple, I would just put the credit constraints, for example, on tradable goods, non-tradable. It's an easy way. But here is a general credit constraint. And why, when you do the intervention, selling reserves, when you sell reserves, you depreciate the currency. So it's you appreciate the currency. So you sell reserves, you reduce B, and loss increases when the constraint is binding. But the opposite happens for reserve purchases, which is contractionary. This is very important. When central banks accumulate reserves in this model, it is contractionary, because what you do is to take the economy and to drive it to the credit constraint region. And that's why so usually when we central bankers used to accumulate reserves in period of tension, I did it in my times, and when we do this currency manipulation, basically we want it to be expansionary, not to be contractionary. In this paper, it's contractionary. This is important. So let me make just some comments. As I start, a purchase of reserves is contractionary, and so why is the rationale to do this contractionary intervention? There is an asymmetry in the sales of reserves. It's also interesting, but the sale of reserves, when you want to appreciate the currency, to strengthen the currency, the real exchange rate here, the usual case in the world is to avoid, is for fear of floating, because you don't want more inflation. In this paper, there is no fear of floating, there is no inflation. There is no even inflation in the monetary version of the model to discuss about fear of floating, which for me is the most important reason why central banks get extremely nervous when the exchange rate when the currency starts sliding. Okay, and this paper has an asymmetry, and the asymmetry there is a rationale to intervene in order to limit a depreciation, because it's expansionary and you basically are providing a foreign currency when the economy is in the credit constraint. In this other case, when there is an appreciation, you don't want to fight the appreciation because it would be contractionary. I think that is the other way around, and this is what has been happening in the world. There has been much more concern of two strong currencies because of competitiveness reason. And I worry a lot that there is a strong discussion, a very long and interesting discussion, where this is currency manipulation, how you affect the global economy adjustment, but I think that this is what happened. So let me talk about the financial frictions, which I think that are the key, and whether this is what's driving the results, which is central in this. There are some other details, and I mentioned in the labor supply, a model of foreign exchange intervention, you don't want to have the action through changes in labor supply. I think that I would look more at demand effects with a fixed labor supply. I don't know if that buys you much, so I couldn't get the intuition whether you have or no your effects when you assume a constant labor supply. But the constraint, I was very worried, and the constraint said basically that you can, the constraint is, this is a K, that you cannot borrow more than X theta% of your net worth. So my concern is why we don't change the constraint and we say sterilization bonds are collateral. So banks can borrow abroad because they have sovereign bonds that in this case are denominated in the same currency. So I would take Chilean bonds denominated in dollars and use them as collateral to borrow abroad, and to have dollars to lend to the private sector. So this is kind of the, so why this, so this is the first constraint. The second is why they cannot sell it to foreigners. I understand that the model has an assumption, but we know that around the world, foreigners have a lot of domestic debt, even domestic debt in local currency. I was thinking, what's happening if you use this, for example, constraint, which is you can use as collateral bonds. Even it could be one for bonds. So you have different sort of effects, and because remember what's happening in this paper. I try to summarize. I hope I clarify. But what happened in this paper is that the government goes and buys the bonds and gives dollars, and then with these dollars you lend, because there is no other way to do it. So, but the one that has the bonds are the banks. Why the banks need to lend? They go and they sell the bonds to foreigners, or in an heterogeneous domestic, to other locals, to institutional investors, who knows. So this makes a difference. So here there are the two constraints. Foreigners hold relevant reserves and domestic bonds. And then why households face an equity limit? It was very difficult to me, because it's not endogenous. And these are assumptions. So why? You say, well, K has a, because if K is elastic, even if you have this constraint, you can always have a lot of net worth to lend. Okay, but K, so households have this limit. So this is very simple to solve it, just to bring foreign banks. Foreign banks have, so locals have a constraint, but we bring Santander, Citibank, and all those banks. Okay, so I won't. Now there is this is done in the paper again. This is done in the paper, but with a thing that I was not so sure is that if there is a spread between, if there is a spread, domestic spread, banks could lend at a higher rate than the foreign interest rate and charge a risk premium. So you don't face a strict constraint. You can pay more for that. And if banks are making profit because there is a domestic credit constraint, you can pay more. Okay? In this paper, he does it, and he does it in the equilibrium. It's done. It's done the case of spread. But this, in his spread, if banks have more net worth, the spread increases. So I got a little bit confused whether this mechanism that we would think that are kind of natural in actual economies work. Here I have the foreign participation in Latin America. I took this from a fun paper, so data must be fine. So it's so the red is foreign banks in Chile, a lot important, Uruguay, Panama, and these are foreign banks of Latin American countries. So in Panama there is a lot, and well, Panama is kind of weird, but I couldn't check it out because I just took this graph. So this is so the solution of foreign banks is something that happens in at least in the case of Latin America, European economies. And the idea is that the debt held by foreign investors in local currency, they even hold local currency. Argentina, of course, these are data for 2015, so Argentina was still out. But then you have the case of Mexico, 30% of domestic debt in local currency is held by foreigners. So there is a lot of liquidity and trading, and you can trade and you can find enough resources. Then what's my interpretation of this paper? In order to make, sometimes countries face credit constraint, and I like this idea that this happens sometimes, okay? And there are capital outflows, sudden stops, and we can call many names. Central banks, to avoid the collapse of the currency, intervene by providing foreign exchange currency. And what they do, they avoid credit crunch, financial stability, and mostly they fear inflation. So this is and this paper makes this point using the standard what should be done now for rigorous analytical work is a DSG, dynamic stochastic general equilibrium solved with Ogbin, which is a daughter of Dinari. But first, it needs some empirical evidence to show that this is a relevant channel. And it would also need some simplified version in order to get exactly what are the things that are going on. And how important is this issue about banks selling reserves? I think that there is, if we see the huge reserve accumulation in the world, it's much more important the accumulation than the sale of reserves. And FX intervention, even during the financial crisis, was moderate. This is exchange rates in the Asian crisis. I have little time, so this was like 60% depreciation of Latin American currencies. In Asia happened the same. 60% depreciation in 6 months. This was the amount that they spent in reserves. On average, this was the Asian crisis. They spent a lot. Now it was 10%. In the worst financial crisis, countries had a lot of reserves, and they used very little. And for example, look at the case of Chile, has a positive, negative. This is mostly our valuation effects rather than actual intervention. Here you see countries that intervene. Mexico, Peru, well, Venezuela is a special case, but it's, so these countries, but still countries that intervene a lot was not that massive. The same in the case of Asia. So in my view, what's the big question that we should ask about reserves and intervention? Why central banks accumulate reserves? Do not use them too much. There is this precautionary and the mercantilistic reason, and because the optimal level of precaution depends on how you compare to the rest of the world, I think that there is a sort of a coordination problem that economists tend to have much more reserves than needed. The mercantilistic motive is asymmetric, and I think that helps to explain the patterns of reserve accumulation. Depreciation is like, appreciation is dislike. And now, purchasing reserve triggers some capital inflow. And this is I want to finish with this. This is a concern that I have a long time ago, so if somebody helps me to solve it. When you intervene in a world of full capital mobility, Bacchus, Quijo, whoever we want to, so in this world, you should get the same inflows, exactly the same. So there would be an offsetting, you don't change the current account, there are no real effects. Okay, and this is what happened, actually. This is Brazil, this is the exchange rate, this is the period of massive reserve accumulation. They start accumulating reserves, which is measured by the sign of, and they trigger capital inflows, almost the same magnitude, quite interesting. The current account moved a little bit, but first order effect was reserves trigger capital inflows. There was some movement in the exchange rate, but not that much caused by reserve because here there was a financial crisis. Massive depreciation, countries stop accumulating reserve because they don't want to push more for a depreciation. This is a case of Chile, the same. Here is the financial crisis, so don't think that this was too effective. So basically, Chile started accumulating reserves here, and it triggered capital inflows. The same here. You know, some movement in the exchange rate. There is some effectiveness, but not that massive. However, this is one view. I would say there is some effects. Most of accumulation of reserve trigger capital inflows, almost the same, so that's why these effects are small. But we have this, which I have been very curious. This was done at the IMF, EBA, has been done by Shin, by Menzi, has been done also by Bergsten and Gagnon. And the accumulation of reserves, the delta reserve, the change in reserve for a set of 20 countries that manipulate the currency because they accumulate a lot, is almost 1-to-1 with the current account. So in this case, for me, would be extremely effective because the reserve accumulation is not changing the financial account. What is changing is the current account and the savings investment equilibrium, which is kind of puzzling. These are my comments.
Thank you, Jose.